On December 14, 2003, the world learned that Parmalat's legendary Euros 5 billion bank account was nothing more than a phantom, a paper trail of forged documents and empty promises that would topple the Italian dairy empire in a single seismic collapse. Founded in 1961 in the modest town of Collecchio, Parma, the company began as a single dairy farm owned by a young entrepreneur named Callisto Tanzi. With a simple vision, produce high-quality milk and cheese for the local market, Tanzi turned his modest operation into a national brand, capitalizing on Italy's post-war boom and a growing appetite for processed foods. By the 1980s, Parmalat was not just a dairy. It was a symbol of Italian industrial prowess, exporting mozzarella, milk powders, and ready-made desserts across Europe and into the United States. The ascent was meteoric. In 1990, Parmalat listed on the Milan Stock Exchange, and its share price surged as investors chased the promise of a company that seemed to have cracked the code of global expansion. The 1990 saw a cascade of acquisitions: the purchase of French dairy group Lactalise's European assets, the takeover of the US-based dairy giant Latticini, and a bold move into the beverage sector with the acquisition of a controlling stake in the German juice maker Sinalco. By 1999, Parmalat's revenues topped Euros 12 billion, and its market capitalization rivaled that of Italy's automotive titans. Yet beneath the glossy annual reports, warning signs flickered like distant lights on a storm-tossed sea. The first was the company's relentless appetite for debt. To fuel its acquisitions, Parmalat issued a string of high-yield bonds, the most infamous being the Euros 3.95 billion Eurobond floated in 2001. The bond's prospectus boasted an unprecedented cash reserve of Euros 3.2 billion, supposedly held in a special account at the Bank of America. Analysts raised eyebrows, noting that the ratio of debt to earnings was climbing faster than the company's growth. But the optimism of the market drowned out skepticism. A second red flag emerged in the company's accounting practices. Parmalat's offshore shell, was used to move cash between subsidiaries in a labyrinth of subsidiaries spread across Luxembourg, the Cayman Islands, and Switzerland. The financial statements presented a picture of liquid assets that, in reality, were tied up in complex intercompany loans and non-existent bank deposits. Auditors from Grant Thornton, Italy, signed off on the figures, but internal whistleblowers later claimed that the auditors had been denied access to key documents and were pressured to overlook discrepancies. The third warning came from the company's aggressive marketing of cash-rich bonds to retail investors. In a series of glossy roadshows, Tanzi and his chief financial officer, Giorgio Catani, portrayed Parmalat as a cash cow with cash on hand that exceeds its liabilities by billions. The narrative was irresistible to small investors seeking safe returns in a low-interest rate environment, and millions of euros poured into Parmalat's bond issuances, inflating the company's market value even as its actual cash flow dwindled. The house of cards finally crumbled on the fateful night of December 3, 2003, when a group of journalists from the Italian newspaper La Stampa received a tip that the Euros 3.2 billion bank account listed on Parmalat's balance sheet did not exist. The reporters, armed with a request for confirmation, were told by the Bank of America that no such account had ever been opened. Within days, the Italian authorities launched a raid on Parmalat's headquarters, seizing ledgers that revealed forged bank statements, falsified balance sheet entries, and a web of false invoices that had been used to inflate assets by over Euros 4 billion. The revelation sent shockwaves through global markets. Parmalat's stock plummeted by more than 95% in a single week, wiping out the savings of countless small investors. Creditors, ranging from Italian banks to multinational suppliers, filed claims totaling over Euros 14 billion. The Italian government, embarrassed by the scandal, moved swiftly to freeze the company's assets and appoint a special administrator. In a televised press conference, Callisto Tanzi, once celebrated as a self-made industrialist, appeared gaunt and defiant, claiming that the mistakes were the result of unforeseen market pressures, a narrative that did little to calm a public outraged by deception of such magnitude. Legal repercussions unfolded at breakneck speed. In 2005, Tanzi was sentenced to 10 years in prison for fraud, embezzlement, and money laundering. His son, Marcello, and several top executives received prison terms ranging from 5 to 8 years. The auditors, Grant Thornton, Italy, faced massive fines and a revocation of their license to practice in Italy, a rare and humiliating sanction for a firm that had once counted Parmalat among its flagship clients. International investigations uncovered a parallel scandal in the United Kingdom, where the UK's Financial Services Authority fined several banks for failing to detect the false bond prospectuses. The aftermath reshaped the dairy industry and left an indelible mark on corporate governance worldwide. In the wake of the collapse, Italy introduced stricter accounting standards and created the Supervisory Authority for Financial Markets, CONSOB, to monitor large-cap companies more closely. The European Union, alarmed by the cross-border nature of the fraud, accelerated the adoption of the International Financial Reporting Standards, IFRS, to ensure greater transparency and comparability of financial statements across member states. For the thousands of Parmalat employees, the collapse meant sudden unemployment, unpaid wages, and the loss of pensions tied to the company's stock. Many families, especially in the Po Valley where dairy farms had depended on Parmalat's contracts, faced financial ruin. Yet the brand itself proved remarkably resilient. Subscribe to The Collapse for more stories like this.